We're throwing out financial intuition and emotion and replacing it with undeniable, stark, black and white arithmetic. We're cutting right through the noise and looking at the absolute laws of wealth. This isn't about hot stock tips or guessing the market. No, it's about the unyielding math that actually decides your financial future.
We're going to methodically march through 5 absolute laws today: the math of time, income versus equity, the truth about leverage, surviving the number 0, and why you must diversify. And then we'll synthesize all of that into a 3-part system you can use right away.
Now, to start off, let's look at something that completely shatters our baseline intuition. Imagine 2 people. On one side, we've got an early saver who pays in for 10 years, invests a total of $60,000, and then just stops completely. They never add another dime. On the other side, we have a late saver going head-to-head with them. This person invests for 30 years, literally putting in 3 times as much money for 3 times as long, a total of $180,000.
But here is the black and white reality of the math. 40 years later, the early saver, the one who put in a fraction of the money, still wins by over $250,000. They were in the same market, got the exact same return. The only thing that changed was when they started. One quit early and still won. It totally proves that the size of your return isn't what makes you wealthy. It's the boring things, like how long you just hold on, that do all the heavy lifting.
So that brings us to section 1, the math of time.
The very first absolute law is that time compounds way harder than money does. And honestly, this brilliantly illustrates why human intuition just fails us. Our minds, they run in straight lines. We expect our money to grow like a staircase, but compounding doesn't work that way. It builds a ski jump. Think about a saver who puts away $500 a month at an 8% return. After the first 10 years, they have about $91,000. It's a modest, kind of forgettable amount. And frankly, this is the stretch where most people quit because it feels like nothing is happening. It's like pushing a boulder that simply will not move. But look at the final decade, years 30 to 40. In that single window, the balance explodes by over $1 million. That's more than 10 times what that entire first decade produced. The saver didn't suddenly find a better investment. The only new ingredient was time. The boulder is just rolling downhill on its own now.
To really wrap our heads around this, we use a neat little mechanical tool called the Rule of 72. You just take the return you expect and divide the number 72 by it. The answer tells you roughly how many years it takes your money to double. So at an 8% return, 72 divided by 8 is 9, meaning your money doubles about every 9 years. Over a 40-year career, that same dollar doubles more than 4 times over. This shows us that starting 10 years late doesn't just mean you lose your first 10 years of savings, it means you literally cost yourself your final absolutely largest doubling. That's exactly why a lower return of, say, 7% left alone for 40 years will completely crush a 12% return held for only 20 years.
All right, moving on to section 2, income versus equity.
So what exactly are we feeding this compounding machine? We really have to break down the stark difference between the 2 kinds of money in this world. The first is cash flow. That's your salary, the rent check you collect. It pays the bills and keeps you alive this month. Think of it like a river. But a river doesn't compound because you consume it. The moment you stop working, that river runs totally dry. The second type of money is equity, ownership in a business, a stake in property. Equity is not a river, it's a reservoir. It is literally the only money that actually sets you free because it's the only money you aren't consuming.
Let's just walk through this arithmetic together. Over a working lifetime, $1 of your labor wages grows at maybe 0.5% a year above inflation. But $1 of ownership, that grows at around 7% above inflation. Over 40 years, that gap is just monstrous. $1 of labor becomes about $120, but $1 on the ownership side becomes almost $15,000. Labor pays you once, ownership pays you while you sleep. And this is exactly why a salary raise just increases the river, but diverting that money to fill up the reservoir is what creates actual wealth.
To cement this idea, let's contrast 2 different earners. We've got a high earner making $200,000 a year who spends all of it. Right next to them is an earner making $80,000 a year, but they own $1 million in equity. If you ask how many years each of them could stop working tomorrow and still eat, well, the answer is pretty startling. The $200,000 earner has exactly 0 years of freedom. The moment the income stops, the whole thing stops. But the lower earner, by using the 4% rule to draw from their $1 million reservoir, can eat indefinitely. Income keeps you alive, guys, but equity makes you free.
Which brings us to section 3, the truth about leverage.
This brings us to the most popular and honestly the most dangerous magic trick in personal finance. Let's mechanically step through the math of leverage. Everyone loves to tell you about the upside, right? You buy a $300,000 house, Put 10% down, which is 30 grand. The bank covers the rest. If the house goes up 10%, your 30 grand becomes 60 grand. You made 100%. But here's the catch. The lever does not know which way you want it to push. If we run the exact same house in the other direction and it falls 10% in value, your loan does not shrink. You still owe the bank everything you borrowed. Your $30,000 of equity becomes exactly zero. A 10% dip just erased 100% of your money. Leverage is just borrowed amplification. It amplifies losses just as powerfully as gains. And in the stock market, a margin call can wipe out your collateral permanently before the bottom even arrives.
Let's look at Section 4, Surviving the Number Zero.
Now we really need to visualize the mathematical gravity of losing money. See, most people think a loss and a gain are equal opposites of equal size. They aren't even close. If you lose 10%, you need an 11% return to get back to even. Okay, that's survivable. But the undeniable reality is that the math curves brutally against you. Lose 50% and you don't need 50% to recover, you need 100% gain. You literally have to double what's left just to return to the starting line. Lose 80%, you need 400%. Lose 99% of your money and you need a staggering 9,900% return just to break even. The whole grows so much faster than the loss.
And if you hit a 100% loss, well, there is no return large enough. Infinity wouldn't do it. Think about it. Everything we've covered so far is a chain of multiplication. Multiply that chain by 0, even one single time, and the whole thing collapses to nothing. No future return can ever bring it back. 0 is compounding's fatal enemy.
This is exactly why the size of your bet matters significantly more than the quality of your bet. Let's look at a casino example. Suppose you find a genuinely excellent wager with an 85% chance to win. I mean, any casino would trade places with you for those odds. But if you bet your entire stack and when you win, you roll all of it into the next bet, if you play that all-in game just 10 times, you survive only 20% of the time. An 85% winning bet wipes you out 4 times out of 5. Not because the odds were bad, but because a single bad outcome ended the game entirely. Survival isn't just the boring part of investing, it is the entire strategy.
All right, Section 5, Why You Must Diversify.
Concentrating your bets is really only rational when you have true insider control, like, say, owning your own business. Everywhere else, it is quite literally just gambling with extra steps. And this perfectly illustrates the unglamorous truth of index funds. Notice that tiny 4% sliver of the market? That little sliver represents the few monster winner stocks that produce the vast majority of all market gains. The brutal truth that the market hides from you is that 2/3 of individual stocks end up losing money. And because you cannot reliably pick that 4% of winners in advance, owning the whole market is the only mathematical guarantee that you capture them. Diversification isn't a weakness or timidity, it is a mathematical hedge against our own ignorance.
Let's bring it all home with Section 6, the ultimate wealth system.
Let's pull these 5 laws together into a single, unified mechanical system for keeping your money. All of the laws we just discussed fall into 3 essential jobs. First up is momentum, getting money to grow by giving it time and feeding it equity. Second is structure, deciding who actually captures that growth, which depends entirely on which way the lever of leverage turns. And third is asymmetry, making sure you are still standing to collect it by surviving deep losses and diversifying. Missing even one of these pillars will cause your entire wealth-building structure to collapse. Momentum builds it, structure captures it, and asymmetry protects it. I highly encourage you, honestly, I challenge you, to ask these exact 5 rapid-fire questions before you invest a single dollar anywhere. 1. Can it compound? 2. Who controls it? 3. What happens if it fails? 4. Is the upside bigger than the downside? And 5. Do you actually understand it? If you cannot clearly answer these questions, you do not have an investment, you only have a hope.
We're going to wrap up this explainer right here. Notice that we didn't use slogans, hot stock tips, or opinions today. We just mapped out the unarguable black and white arithmetic of wealth. As the saying goes, none of it is clever, all of it is true. So I'm going to leave you with this final, provocative thought. When you look at your current financial strategy, are you relying on the absolute certainty of math, or are you just hoping for luck?